Right today. My forehead's shiny. We are live.
We are live.
Well, welcome everyone.
I can't be the producer. I pushed the dark bubbles button in the background as opposed to the opening clip. Guys, I'm sorry.
Yeah, we just ruined the day. So, well, it's good to see you. By the way, for those of you watching, welcome to the Real Investing Show. My name is Stephen Earp, and I'm a co-host with the great Taylor Davis, real estate mogul. I'm not sure what the word mogul means, but
I don't know, but I like it.
Cool.
And there's always we got guru, mogul. We could go with I don't know.
For a lot of years I was a pastor and a Christian pastor here in Oklahoma, and different cultures use different titles. Like if you go to Africa, the pastors are going to have titles that are like that long. It has to do with power distance. And yeah. So it's like middle class America. Churches here, people go to church wearing like jeans and shorts and pullover shirts. But in most minority groups, people are dressing up, like massively dressing up. And like the pastor, there'll be a power distance. There's like the pastor has the great big pulpit and stuff like that. And if you go to a middle class church here in the US, the pastor's like, yeah, my name is Joe, where in other parts of the world, they're like, this is the great illustrious, apostle, visionary leader, pastor, reverend. And
it's amazing how much culture infiltrates that, because I can only imagine it has to do with like middle class American, or just Americans being really skeptical of power. Like,
yeah, so there's a lot of research on that actually, and it has to do with, this is totally not what our show's about. There might be implications for business, so let me just go down this road for a minute. But culturally, power distance is where you see a difference between the person in power and the person not in power. And in low power distance cultures like ours, we tend to deny the existence of power. So power is where you can make happen what you want to have happen and prevent from happening what you don't want to have happen. Okay. So different people some people are really powerful and others are not. And in our culture, we don't like to think about that, because if we're going to meet up at some networking event in Norman, Oklahoma, and all the business owners, and we want to sit around a round table and kick it around and everybody has ideas. But in the room, everybody knows that one guy sitting at the end that owns half the city of Norman is more powerful than the rest of us. Just like to not
pretend that that's not the case.
But we just pretend that's not really the case.
Okay.
And it's the same with churches and pastors and stuff. So in our culture, we deny the existence of power. But in like tribal cultures, for example, let's say in sub-Saharan Africa, they come from a tribal and a chief-oriented culture where the chief has all the power and the people living in the village have none of the power. And they actually feel safer, because the stronger your chief is, he can protect, or the stronger your medicine man is, or your shaman, or whatever, the more he can protect the whole village. And so you want there to be a distance. You don't want to think that guy's just like me. You want to think that guy is one of the Avengers, and he can protect all of us. And so it's kind of like that. So
interesting.
Yeah, I don't know the implications of that for business, except in terms of when you're negotiating with people from other cultures. The more you can give them honor and the more you can respect them, the better off you are usually. And rather than just sitting down at the table and saying, okay, Joe, Mr. Decamillionaire, let's talk about this house you want to sell me.
They want the power, or okay.
Yeah. So I don't know. How did we get off on that? Oh, here's what it was. What do we call ourselves? Well, I called you a mogul and you didn't like that. And so, and a guru, that sounds a little weird to me,
I got a buddy of mine that he has real estate guru on his shirt, and I give him a hard time.
Guru. That's a weird word. It's a weird word anyway. But when I was pastoring, I used to tell people, they would say, what do you want? What should we call you? Do we call you Reverend? I was like, whoa. I don't know about that.
Just call me Joe.
Yeah. Just call me Stephen. But then I started telling people I would prefer to be called the illustrious potentate. And they were like, what? Potentate, the illustrious potentate. They're like, I don't even know what that means. I said, okay, if you can't call me that, just call me Steven. And
Okay.
So, yeah.
So next time when we introduce ourselves, you're going to say, I'm here with Taylor, the great Taylor Davis, real estate mogul, and I am
the illustrious potentate.
The illustrious potentate.
I don't know how that relates to real estate.
I don't know, but I'm going to just turn this train real quick and go, let's talk about financing options.
Yes.
In real estate, because there's so many and people don't know the best ones for them.
Yeah.
And we all know that the bank has the power.
Yep.
So
nice. That was such a nice segue to an awkward topic.
So how let's talk about different financing types.
Yes.
Out of curiosity, Steven, to this point, what have you used the most often and why?
For financing houses,
yes,
you mean? I don't know. I'd have to look back on my records, but it might be 50-50 between number one, I've used probably half of my deals I've done in my lifetime have been financed by either a mortgage company or a bank. And mortgage companies, meaning in my early days of buying houses, you could get initially you could get an FHA loan if you're going to live in the house. You live in the house for a year, then move out, and then then you go to conventional loans, and you can get up to 10 loans that are mortgage-backed loans, and they have the
these are your traditional 30-year fixed or fixed rate up to 15 or 30 years.
Yeah. So there's that. So I did as much of that as I could do depending on the deal.
All right, pause.
Yeah.
Why did you do as many of those as you could?
Because since the government backs them, the interest rate is the lowest and the down payment is the lowest. Okay. So that they are the best loan product. The interest rate is the lowest. The down payment's the lowest, and not only that, but they have the longest terms. Mm-hmm. So you could get up to a 30, sometimes even a 40-year loan.
This is what the average homeowner is going to have. This is what most people are most familiar with. It's going to fall into, there's VA, there's FHA, there's conventional, but all of these are a 15 to 30-year product at a kind of almost artificially low interest rate that because they're backed by the government. So it drops that interest rate. These are also going to have your little box that you have to qualify for. The downside is you've got this box that you qualify for that's going to be based off your debt to income ratio and your credit score. So this is just a very clean little package. If you fit in the box, great. If you don't, the limitations are there. You can only have one VA loan, one FHA loan, and up to 10 conventional loans. Your first 4 are a little easier to get. And your last 6 are a little harder to get.
Yep. And if you're just getting started in real estate, you should do whatever you have to do to try to get a conventional loan or a FHA loan on your first deals. It doesn't make sense. There's no comparison in terms of the savings that you'll get. So if you're just starting out, you need to use FHA. You need to use conventional. If you're military, maybe VA. Sometimes VA is better. Sometimes it's not. But
And with this, you do have to live in the home for 12 months with the FHA or VA. And so those need to be your primary residence for 12 months.
You have to intend to stay in the house for 12 months. Yeah.
Okay.
Yeah. So yes. Now then, so in the category of borrowing money traditionally, I would say half of my deals have been some form of mortgage or bank financing. So we talked about mortgage financing. Now, bank financing tends to be when you find local banks that will loan on different types of products. And these tend to be the most flexible. They tend to be the most user-friendly. They tend to be the most relational. And so this is where you have a small credit union, you have a local bank, you go get to know the loan officers, and they do the loans, and listen carefully what I say with this. They do the loans in-house.
Yeah.
That means it's their bank, it's their money, it's their interest rate, they're setting the terms, they're doing all of the requirements. And the value of bank loans is a lot of times you can find a bank where they say, we're going to specialize in these types of loans for investors. We love houses like this. A lot of times they'll loan you more money more easily. Last fall, we found 2 different banks that would loan money for rehab properties, and they would actually loan 100% of the price of the property, and they would loan all of the rehab money. And literally at closing, you're coming away with money. So
yeah, so these are going to, again, these are local. This isn't JP Morgan Chase. This isn't Bank of America. These are local small banks.
Yes.
And they're lending out their money, and they get to make the rules. So they may not care so much. They're going to care about a lot of things, but they may not care so much about your debt to income ratio as much as like looking at the deal, seeing your history of making good payments, seeing your net worth overall, and then knowing that you have that ability to make that payment moving forward. And usually, like, correct me if I'm wrong, on the deals where they lend 100%, they lend 100% as long as there's enough equity, right? So,
yeah. Oh, yeah, of course. Yeah,
so,
they want it.
Yeah, they'll lend you. You're buying it at $100,000, but it's worth $125,000. They'll give you the full $100,000 because there's still the value there on the back end, right?
Yeah, and here's the thing about this. If you're looking at the difference in a mortgage versus a local bank loan, mortgages are federally regulated. And I'm sure banks have federal regulations as well, but they're loaning out their money so each bank is more unique. So when it comes to local banks, you really need to build the personal relationships. Some of them, though, bro, like back in the day when I bought my very first rental property, I was 19 years old. I went to the bank. My aunt took me to the bank, and she had like 30 properties with this local bank. And she said, hey, this is my nephew. Can you help him with a loan on this rental property? It has 40% equity in the deal. They literally that day got a loan for me. She didn't have to co-sign on it or anything. They were like, we like how she does her properties. She knows what she's doing. This is her nephew. We don't think he'll fail. So so a lot of times relationships make a big difference. Yeah. If it's in a small town, and here's the deal about small towns. Small towns usually will lend in other areas as well. That's the thing people don't realize. Sometimes a small town bank that's 3 hours away, they will loan to you money in your own backyard as well.
Yeah, actually, a cousin of mine. So one of the very first flips that I did with Hillary was a damaged house in the Moore tornado in 2013. I mean, so this is kind of a scary deal to a lot of people because it was damaged in a tornado. And my cousin is a banker in Wewoka, Oklahoma, which is like an hour and a half away. And but I went to him and I was like, hey, here's the deal. Here's my credit. Here's all this. I was only asking for like $30,000, but they lended it to me and an hour and a half away. So usually it has to be within the same state. These are also you'll hear them called in-house financing or portfolio loans. So portfolio loans is like when we're going to continue to lend as you build your portfolio or on your whole portfolio.
Another side benefit, which this might be a little bit of a gray area ethically, but most of the time the local bank loans will not show up on your credit. Normally they will, so
if they're keeping it in-house.
If they're just keeping it in-house, they may not care about those things. So and most of these bank in-house loans will be based on your personal finance spreadsheet. It's like, here's my financials. Here are my financials.
Yep.
And so you can have it in advance, where a mortgage will be like, we need this in this form, in this way, and this and this and this, and check off the box. A lot of times these local banks are like, well, do you have a financial, can you send us your financials?
Financial statement. Yeah.
Yeah. Financial statement.
That's why it's important to have one and keep one. And they'll even send you a form to be able to build one if you don't have one.
Yeah. But most of them are really relational. You get a hold of these. So make as many relationships with local banks as you can. And you can really, really, really grow your real estate holdings that way.
Upside to these is they're not stuck in the box. There's no limit on how many you could have per se, just up to that individual bank. They're going to work with. Downsides are going to be they're not a fixed rate. They're not a long-term fixed rate. So usually what I see is it's either amortized over 15 to 20 years,
right?
But it's going to only be fixed for 3 to 5 years.
Yeah.
You're also going to be at a higher interest rate. So if I were able to go out and get a loan with a mortgage, and let's say that's going to be at 6.5% interest, going to one of these banks, I'm probably going to be paying 7.5%, maybe 8% interest.
Yes.
And I'm only going to that's only fixed for 3, maybe 5 years.
Yes.
And then in 3 years, it's going to jump to whatever interest rates are. So if interest rates have gone down, it'll go down. But if interest rates have jumped up to 12%, you've jumped up to 12%, you're not fixed in at that rate. So that's the offset to it.
Yeah. Yeah. Well, and you just have to know that. You just have to know and make sure it works for you.
I keep a spreadsheet of my properties, and I go through and color code them as the years are coming up. So I know that I'm a year out from this interest, because I have several right now that I'm like a year and a half or almost 2 years out from jumping from like a 4% to whatever it's going to be. And we know it's not going to be 4%.
Right.
So I have to be prepared for those numbers to no longer work.
Interesting. When the subprime crashed in 2008, 2009, I had a number of loans with one particular bank that I initially grew up in this town, or not grew up in this town, but my early married life, I lived in this town. And so they had some properties for me in different parts of the state. And when things started crashing on the subprime, when the subprime mortgages started crashing, when it first started, I had 8 houses that were under construction. Okay. So I was making payments on 8 houses. I had 3 full-time crews that were working for me at the time, working on these houses. So it was scary. We didn't lose. We lost equity, but we did not we didn't have anything going to foreclosure or anything like that. Interesting. This bank that I had this loan with, that I had multiple loans with, I had a loan with them in Purcell. I had a loan with them in El Reno, which was like an hour and a half away from them. They started calling me, and 2 of the properties I had under construction. And they said, okay, we drove by these houses and we see they're under construction. We know the market's doing crazy things. And so we just want to stay in close contact with you to do whatever we can to help you. And I know that translates into, we're afraid that some of our borrowers are not going to pay. And so we just want to be notified real early if that happens. And so for me, they literally called me every 4 to 6 weeks for like a year and a half while I was working. And one of the properties, because banks do not like loaning money on properties that are going to be long-term vacant. Right. Well, one property, I was having major cash issues. And so I was like, I don't know what to tell you. I cannot do anything with this house. I can keep it boarded up. But I cannot fix it and these others right now. And they're like, yeah, no problem. At some point, your insurance company is not going to want to cover it, because if the insurance company knows it's vacant, they don't like that. And so they're like, so we just want to let you know the insurance company may have a problem at some time. We're definitely not going to call them about it.
but that would become their problem. The last thing they wanted in 2008 was your house.
Yeah. And so, so they just walked with me through the whole thing. I never missed a payment. On one of them, they said, hey, would it be helpful to you if we turn this payment into interest only? I was like, let me think about it. Yes. And so and another one, they said, here's what we're going to do. Since you're working on this one actively, we're going to restructure your loan, and we're going to give you 6 months to do this construction work. And you're not going to have any payment or any interest for 6 months.
Wow. Because it's in their best interest to work with you.
Yeah. So,
and you have the relationship too. I love local. Yeah.
Yeah. So so initially your question was, I don't know how much time we have left, but initially your question was how much of my deals were, what kind of financing was it? And we talked about mortgages and we talked about local banks. About half of my deals have been some form of owner finance. And that is where the owner of the property, or let's say private finance. So maybe 3 different ways of private finance that I've used personally. And about half of my deals that I've ever done are like this. One would be when the owner of the property carries the note and they just finance the property for you. And my very first house that I ever bought was like that. I had a couple of ladies that carried the note for us on my very first home, and it was on a 10-year note. And so they were like, just give us $400 down and you can pay us out over the next 10 years. And so that was in 1993.
And that can look, there are so many different ways that private financing can look. It can be a rent to own. It can be a lease purchase. It could be a contract for deed. It could be, there's just, which are all the same things, just a little bit differently tweaked.
Yeah.
It could be a subject to, which we had an entire episode on. Mm-hmm. It could be or the other piece to it is that private financing. And so that you've got the bank financing side, you've got private financing side. So private financing could be the seller financing it. It could also be private money that you're either raising from people that you know, or you're going to someone like a hard money lender. And talk to me about, we have like 3 minutes. Talk to me about the benefit of the private financing.
Yeah. So the house I'm living in right now, I don't know if you knew this, but I was looking for, this was in 2011. And my wife was wheelchair bound. I needed a 1-story house. The house we were living in previously was 2 stories. So I was rehabbing houses and, doing some flips and things like that. I found the house I'm living in now. It's 2,500 square feet. It's all 1 floor, and it was better for handicap accessibility and things like that. I contacted a friend that I was flipping houses with, and he came and looked at the deal, and he was like, Stephen, this is a house you need to live in. And I said, I know. I don't have the cash for it, and I don't want to borrow money right now. And, stuff like that. And he said, listen, I will lend you the money on this house. You do the rehab with your money. I'll lend you the money on the house. I'll loan it to you at 4.5%. And at the time, that was about 1.5% below what I could have gotten on a mortgage.
Okay? Oh, wow.
So, and I'm going off memory, so my memory may be hazy on some of that. But so the house I'm living in right now, that's getting close to paid off. I bought it in 2011. And a friend of mine just said, well, I have this money. I just sold this apartment complex. I have this money. And we're not finding enough deals for me to put my money in. So I'll lend you the money for this house if you can pay me 4.5% interest for 15 years.
Wow. So
that is, and it's getting closer to being paid off now. So that's another way that you can use private money to, and I've done the same. I've had investors that have lent money before on houses. Sometimes I'll pay them an interest rate, like, hey, I found a deal. I need $75,000. And they're like, well, I have $75,000. And so sometimes I'll just pay them an interest rate. Other times I've paid them an interest rate and given them some percentage of equity in the deal. Okay. And so that's another way that I've done it. And at one time I had, I don't know, maybe 10 or 12 houses like that, where I had different arrangements with different people, different family members.
And to them, it's completely passive, and so they're getting interest on their money that there's probably better than they'd get at the bank or, in a bond or something secure. And they're getting a piece of the back end potentially on some of those deals. Right. So that's the advantage to them.
Yeah. So different kinds of financing. I know we got to wrap up. You get the traditional mortgages. You want to start there. Banks, build relationship with banks, and then private money is always helpful. And that could be in the form of a subject to, that could be a form of owner finance, or that could be in the form of someone else loaning you money on your deal. So any closing thoughts, Taylor?
Man, you wrapped it up good. I can't do better than that. It's like
Christmas. All right. This is the illustrious potentate and the real estate mogul guru from Norman, Oklahoma, the great Taylor Davis. Thanks for watching, guys. Please like, comment, and share. Send us your real estate questions. And let us know how we can help you. Thanks a lot.
Bye, guys.